Chapter 2, Why Real Estate? If you've bought this book, chances are you're looking for ways to make money. You might be intrigued with the idea of a passive income stream, or income that works when you don't want to. Or perhaps you just relish the idea of telling your boss, "I quit someday soon." Maybe you're experiencing the feeling of, "I don't want to miss out," as you hear about the success stories of other real estate investors. Or it could be that you're already a successful real estate investor and are looking for the insider's tips to take your current investing to another level. No matter what level you are currently at, or what outcome you want from your real estate investing, the benefits you get will be directly related to how much you utilize all the wealth-building attributes of real estate. Owning real estate is not the only way to get rich. However, it is an easy way to begin building wealth. And real ease. Tate investing is the easiest way we know to build wealth, using the principles of leverage and taking full advantage of legal tax loopholes. Why real estate is better than stocks. The beauty of real estate is that it offers several opportunities for leverage, something that the stock market does not. For example, say you have $20,000 to invest, and you are trying to determine which would be a better investment. Let's take a look at your options. Option 1. You find a property in a borderline neighborhood that is close enough to town that it could become gentrified. The property is run down and costs only $150,000. You put down a 10% deposit of $15,000 and plan to spend the other $5,000 on upgrades. Option 2. You invest $20,000 in the stock market, $10,000 in blue chip stocks, and the other $10,000 in an aggressive mutual fund that is targeting biochemical ventures. Now let's go forward in time, not far, just a month. Let's see where our two investments stand. Option 1. The upgrades have been done, and the house has been rented for enough money to pay your mortgage, insurance, and all other monthly expenses associated with the property. You now have a financially independent asset that cost $155,000, but is really worth much more. Based on your smart assessment of other values in the area, you knew that the $5,000 you put into upgrades would give you a property worth $175,000 when you were done. You now have total equity of $40,000 from your initial $20,000 investment. We call that active appreciation. Option 2. The blue chip stocks haven't really moved. The Biochemical Ventures Fund has risen by 10%. You now have stocks worth $22,000. Do you see what happened here? By leveraging your money into a down payment, you have secured an asset that is self-sufficient. It's paying for itself without any more immediate input from you, and your $20,000 is now worth $40,000. The stock market, on the other hand, doesn't have those same opportunities to leverage. If you want to buy $20,000 worth of stock, you need to have $20,000 to start with. Hopefully, your investment will increase along with the stock value. But even if it does, you'll be waiting a long time to see the same level of profit you got from your property after only 1 month. That's the beauty of leverage. Yes, you use $15,000 of your own money to purchase the property, but you used $135,000 of someone else's money. And what's more, because the property is renting out for slightly more than it's costing you to cover the mortgage, insurance, and so forth, you're making a profit on someone else's money. Here's an idea to think about. What do you think would be more likely? Getting a mortgage loan from your bank manager, or getting a personal loan from your bank manager so that you can go and play the stock market? Even if you are buying blue chip stocks with the loan, there is still no guarantee that those stocks won't crash at some point and be worthless. The property that you purchase, however, will still be there and is far less likely to lose money than the stocks. There is nothing intangible about real property. It's right there, on the street. Pink, purple, blue, green trim, white trim, French windows, Cape Cod shutters, and so on. Your bank manager can drive by and see it for himself, or herself, every day after work. You can use the property as collateral for the loan money. You can't necessarily do that with the stock market. Have you ever noticed that there are considerably more advertisements in the newspaper, on television, or in your email inbox offering mortgage finance than there are advertisements offering you money to invest in the stock market? Why do you think that is? And why do you think the rates are so much lower for mortgages than they are for personal loans? Property is a safe investment from a bank's perspective. And the safer the investment, the more likely your bank manager is to look at you, smile, and write a check. Here's another idea. What do you think is more likely, that you locate an undervalued property or that you locate an undervalued biochemical stock? There are many reasons why a property may be undervalued. We live in a society that loves instant gratification. For some people, selling the house and moving on is just another item on a long list that is waiting to be crossed off. As long as the offer is reasonable and you can close quickly, they'll take it in the interest of moving along. Estate sales and divorce sales are two other areas where you can often find a bargain. A family member who has little or no property background, charged with disposing of grandmother's estate, may be more inclined to take a lower offer to get the place sold than a savvy real estate agent would. And for a couple divorcing, the end cannot possibly come soon enough. Now, what about stock? Sure, there can be great reasons for it to be undervalued. There might be research in the works that will pay off in the end. There might be a company lurking out there that wants to take over the undervalued company. However, in many cases, it's going to be much harder to figure out which stock is undervalued and which isn't. If the company has released information about its research, you need to be able to understand what it is doing and why it will be successful. That's assuming that you can get hold of all of the information, which isn't always the case. With real estate, on the other hand, it's much easier for you to find a bargain. And for yet another angle, let's go the opposite way. Which do you think you are more likely to come across? An overvalued property or an overvalued stock? Of course, there are overvalued properties, especially in very hot real estate markets. A buying frenzy in one particular geographical area can push property prices out of reason very quickly. As an inexperienced real estate investor, you may be afraid that you will be the one to buy the bad deal and have everything go wrong, especially right now with the intense popularity of real estate investing in the United States. However, this is also an area where you might find yourself getting help in sorting deal from disaster from an unlikely source, your bank manager. Remember, your banker has a vested interest in your success and probably has a lot more experience than you, especially in your early days. Your banker is likely to put the brakes on a lemon. Of course, appraisers, real estate agents, and property managers can also help you make a lucid decision. As for overvalued stocks, well, that story speaks for itself. Between March 2000 and October 2002, during the dot-com crash, the Nasdaq Composite fell by 78%, from 5046.86 to 1114.11. Since that time, the American public has had to deal with multiple instances of stock manipulation and outright fraud, both on the part of major public companies and by stockbrokers and stock promoters. When was the last time you saw a piece of real estate lose 78% of its value? And when was the last time one of your advisors hyped an overpriced piece of real estate because he or she stood to gain personally? Okay, let's go back to the beginning of this discussion, back to you and your $20,000 initial investment. One of the things that you did with your property was to spend $5,000 on renovations, which enabled you to get a tenant paying enough in rent to cover your mortgage and all of your other property-related expenses. Now, could you do the same thing with your $20,000 stock market investment? Spend a bit more money and enhance the value of your stock market investment? The answer is no. As a stockholder of a public company, You have very little control over the business of that company. The key business decisions are all going to be made by the officers and directors of that corporation. You, as an investor, are left with two options: sell your stock or have faith in the company. You could spend another $5,000, but all you would get for your money was another $5,000 in stock. Here's one final thought on why real estate is better than stock. Let's say that the neighborhood saw a general increase in values, and your $150,000 house, which you turned into a $175,000 house, has appreciated to a $250,000 home. And let's also say that your $20,000 stock investment has also appreciated and is now worth $28,000. How can you access some of the profits without disturbing anything? With your real estate, the answer is pretty simple. By refinancing your mortgage loan, you can withdraw plenty of equity. After all, you've seen great appreciation, and use that money for all sorts of things, from a trip to Mauritius to a co-op in Manhattan. And because you have so much equity in your property, you will very likely be able to finance on better terms than you originally received. Plus, your tenant is still there, the property is still turning a profit, and you are still leveraging someone else's money. In fact, once you refinance, you'll likely be turning an even greater profit, especially if your loan costs are reduced with the new financing. With your stock investment, the answer is not quite as satisfying. To get money out of your investment, you're going to have to sell some of it. You'll have to pay taxes on what you sell, of course. And you'll wind up with a smaller investment, and that means less future profit. Can you make money with stocks? Of course you can. But we maintain that it will take more diligent study and harder work to find the best niches in the highly competitive stock market. Real estate is slow but steady. To be honest, it's even a little boring at times, but it's how both of the authors have made and kept their wealth. Benefits from real estate. There are actually 4 benefits you can receive from real estate. 1. Passive appreciation. 2. Active appreciation. 3. Cash flow. 4. Tax benefits. Passive appreciation. Passive appreciation means the property goes up in value without your help. Dolph frequently tells his sellout seminar attendees his personal insider's secret to maximizing passive appreciation. In the United States, property on average appreciated by approximately 9% last year. If you want better than average results, look for areas that historically have had better than average growth. For example, here is a sampling of appreciation rates per state from the Office of Federal Housing Oversight. House price appreciation by state, percentage change in house prices for the period ended June 30th, 2004. State, Nevada, 1-year percent, change 22.92, 5-year percent, change 53.06% change. Since 1980, 183.37. State, Hawaii, 1-year percent, change 1890, 5-year percent, change 53.79% change since 1980, 255.49. State, California, year percent change, 18.39, 5-year percent change, 84.10% change. Since 1980, 338.72. State, Rhode Island, year percent, change, 1786. 5-year percent change, 87.78% change. Since 1980, 383.92. State, District of Columbia, 1-year percent change, 1607. 5-year percent change, 95.10% change. Since 1980, 316.06. State, Florida, 1-year percent change, 1423. 5-year percent change, 61.28% change. Since 1980, 208.96. State, New Jersey, 1-year percent change, 12.75, 5-year percent change, 64.97% change since 1980, 329.40. State, New Hampshire, 1-year percent change, 1039, 5-year percent change, 71.13% change since 1980, 318.61. State, Massachusetts, 1-year percent change, 979, 5-year percent change, 73.38% change since 1980, 528.62. State, United States, 1-year percent change, 936, 5-year percent change, 43.59% change since 1980, 218.03. State, Michigan, 1-year percent change, 399, 5-year percent change, 27.86% change since 1980, 215.42. State, Indiana, 1-year percent change, 3.05, 5-year percent change, 18.20% change since 1980, 138.67. To be updated on the latest trends in appreciation for free, please register at our website, www.dolphanddiane.com.
Neighborhood appreciation. Not only do some states have higher appreciation rates than others, but within states, some cities have higher appreciation rates than others. For instance, in California, a highly appreciating state in its own right, San Francisco, Los Angeles, and San Diego typically appreciate at a much higher rate than Eureka, Lodi, or Thermal Grasshopper. Similarly, property often appreciates at different rates within different neighborhoods in a city. To find an area on the upswing, drive around and look for signs of rehabilitation, signs that a neighborhood is improving. More than 10% of homes in the neighborhood are getting new roofs. Large industrial dumpsters in front of buildings. Freshly painted buildings. New evidence of landscaping. You might also see a number of for sale signs as you drive around a neighborhood. This isn't necessarily a bad thing. If values have gone up significantly, the for sale signs might be evidence of some profit takers selling to take advantage of the increase. It could also mean that there is something bad happening or about to happen in the neighborhood. A large number of for sale signs means something is going on, but don't jump to conclusions on what that might mean. The one thing you can be certain of is that it might mean you will have a lot of competition if you buy a property for a quick sale. If you are buying a property to generate a quick sale, though, be aware of new house construction in the area. It is often hard to sell an older house in a market where there are new houses with new warranties available for potential purchases. Generally, the only benefit that an older house can offer would be charm, and it would have to be a substantially older house to have that, or good landscaping. Active appreciation. You're already familiar with active appreciation and might not even know it. Active appreciation comes about when a property goes up in value with some outside help by way of fixing it up. Some examples of active appreciation are updating a house, constructing a garage, putting in landscaping, cleaning the property, painting the property, changing zoning for better use. One of Diane's favorite examples of active appreciation concerns one of her office buildings in Phoenix. Diane and her husband bought the house when it was a single-family residence in historic Phoenix for $239,000. In fact, they paid full price for the property. That's because the property had zoning on it that would allow conversion to professional offices, which is exactly what they did. With the change in use, the property was suddenly worth $329,000. An appraisal provided the value. They immediately refinanced the property and took out money, tax-free, to use for other investments. And Diane's offices are still partially housed in this great little historic craftsman bungalow in downtown Phoenix. Tips for improving your residential properties. Dress up the front of the property. Flowers, paint, a brightly painted door. Clean up both the inside and the outside of the property. Update the house with new carpet, floor coverings, and paint. Change the sensory perceptions. For example, make it smell good. Add a garage or carport if appropriate for your area. Change knobs on the kitchen cabinets to modernize. Install an alarm. Tear down a rusty shed. In fact, Dolph is so excited about how easy it is to create value that he's written a book full of ideas on how to make changes entitled 101 Ways to Massively Increase the Value of Your Real Estate Without Spending Much Money. Multifamily and commercial properties generally see increased value due to increased cash flow and profitability. Increased cash flow usually means increased rents and other sources of income. While it is possible to stop fixing things as a way to increase the bottom line, we do not recommend deferring maintenance as a way to raise the cash flow on a property. Tips for quickly improving the value of your multifamily and commercial properties. Add storage units. Add coin-operated laundry. Increase rents if they are currently under market value. Fill vacancies by first determining why the vacancies exist. Change primary tenant focus to create more value. Split a large vacant space into smaller rentable areas. Target tenant needs. In today's highly appreciating markets, it's become harder to find properties that create positive cash flow. One strategy is to look for ways that you can change the use to generate higher rental income. At the same time, you'll often create active appreciation as well. In college towns, student housing is often in high demand. The Arizona State University, ASU campus in Tempe, Arizona, is no exception. Recently, a resourceful contractor purchased a multifamily unit consisting solely of tiny one-bedroom apartments near the campus. The units were dark and outdated, so the property didn't sell at a high price. Other investors had looked at the property, and by the time they factored in the high cost of renovating all of the kitchens, as well as new floor coverings, paint, and the bathroom renovations, it just didn't make sense. The resourceful contractor had another idea, though. He bought the building and then combined the apartments into larger units. 3 former one-bedroom apartments were combined to make 3 suites with a large common area with 1 kitchen, 1 living room, and 1 family room. Instead of renting the one-bedroom units for $450 per month, he now gets $1,100 per month for each suite because he had done such a great job with the renovation. Yet the renovation was significantly cheaper because he had only redone 1/3 of the kitchens, often the most expensive part of a remodel. He ended up refinancing to take all of his invested cash out and now has passive cash flow of over $5,000 per month. And the property is worth a lot more too. Property value is up, now what? With both active and passive appreciation, you are left with the question of what to do now that the property has gone up in value. It's really tempting to sell and take the cash. If you believe that the property might decline in value, it might make sense to sell. You can sell the property either outright or by carrying the note. If you have held the property for less than a year, you will pay tax on any capital gain at your marginal income tax rate. If you have held the property for over 1 year, you will pay tax on any gain at the current capital gains tax rate. You will also have to recapture previously taken depreciation and pay tax at a higher tax rate for that portion. Alternatively, you could also sell the property through a Section 1031 exchange. This is also known as a Starker exchange or like-kind exchange. You will be able to roll over your basis in the property into another property, thus deferring the tax on the gain. You must identify another property within 45 days from the date of sale and close on a property within 180 days. You cannot take any cash from the initial sale, and you must purchase a property worth at least as much as the property you sold to fully qualify for the tax deferral. Even better, if the property still produces cash flow or is in an area that is appreciating or is likely to begin appreciating again, don't sell. Instead, refinance the property to take out the equity. The interest on the additional funds will still be tax deductible as long as you've reinvested the money. If you take the extra money for personal use, the interest won't be tax deductible. But regardless of the deductibility of the interest, you will still have the property, plus you freed up the cash that was trapped within the equity. Cash flow. Cash flow from the property is crucial for you to pay property tax, interest, maintenance, and other expenses. In the case of real estate, cash flow is generated by rent. Cash flow is not the only sign of a good property investment. Since vacant land generally doesn't have rental income, it is not even an investment under this definition. For the same reason, banks are reluctant to lend money secured against vacant land. And even if they did, then the mortgage interest as well as other costs of the property tax, weed control, insurance, improvements, are not currently tax deductible. This is because the property must be generating taxable income before expenses can be claimed as a tax deduction. Every property has cash flow. The question really is, which way is the cash flowing? Is it flowing to you or to the bank? If the cash comes to you each and every month, you have a positive cash flow. The other direction is called negative cash flow. It is good practice to estimate the cash flow from a prospective property before you buy. We recommend that you estimate the cash flow with the following formula. Rent, based on numbers you have verified yourself. Less. Vacancy. Use vacancy rates that are common for your area. Insurance. Property management fees. Property tax. Repairs. Utilities. Conduct a rent survey. When? Conduct a rent survey before you make an offer on a property and periodically after you have bought a property. Why? To ensure that you are charging market rents for your property or that you have used market rents in your projections. Who? The best person to conduct a rent survey is you or someone you really trust. How? Knock on a few doors in the neighborhood and ask, what do you think I would pay in rent for an apartment or house like this in this neighborhood? Some reputable property managers may also give fair market rent advice. Rent. Unfortunately, this is one of the areas that might get a little puffed up in the sales process. You'll find some pro formas, estimated profit and loss statements, that are given by anxious sellers, showing what rents should be instead of what they actually are. Of course, the real question is, why are the rents not at these optimistic levels as quoted in the pro forma? Do yourself a favor and check out the rents by doing a rent survey. The best way to do a rent survey is to go knock on a few doors. Vacancy. The vacancy factor is the best guess of how often the property would be vacant. Vacancy often has a bigger cost than just the loss of rent, though. If you have a lot of turnover in a property, you will spend more money on maintenance items. Often a unit will need to be painted after every tenant moves out, for example. Insurance. Insurance costs are on the rise. Make sure the pro forma you see for the property shows an increase in this cost from the previous year. It's also a good idea to see the past insurance history for the property. Unfortunately, prior claims can affect the insurability of the property when you purchase. Check this out before you buy. You can order a report of past claims called ACLUE report from www.choicetrust.com. Property management fees. Unless you are planning to work for free, there will be a cost associated with managing the property. Some people try to trick the numbers by volunteering their time to manage and maintain the property. That's not a bad idea, but there is a cost to doing that. One of the costs will be that you are limiting how much other work you can do, such as looking for your next deal. You might soon discover that the three most expensive words in the English language are do-it-yourself, property tax. The property tax cost is an easy one to check out. Verify the estimated property tax amount is correct by checking with the assessor's office. Repairs. If there's a problem with the pro forma, it will be in one of two areas: rentals or repairs. Have a property inspector check the property prior to purchase as part of your due diligence. The few hundreds of dollars that the inspector will cost, up to $1,000 or more, if it is a large multi-unit project, could very well save you many times that amount. There are generally two parts to the repair cost. One, deferred maintenance that previous owners didn't handle, and two, ongoing maintenance costs. Your inspector can likely help you estimate the cost of the deferred maintenance. The repair costs on an annual basis will vary based on the part of the country in which the property is located and the age of the building. For example, air conditioners need to be replaced after just 5 years of use in Phoenix, whereas weather damage due to snow will cause excess expenses in the Northeast. Talk to other real estate investors to get a handle on maintenance costs, or talk to an advisor who has other real estate investor clients. The point of all of these calculations is to estimate the cash flow from a prospective property before you buy. Use it as the beginning estimated budget to refine your calculations if you buy. Compare the estimates to the real numbers to get better numbers for the future estimates. Go to Figure 9.1 for an easy-to-use form that summarizes all of the above information on just one page. You can also check out software to analyze real estate at www.dolphanddiane.com. Tax benefits. The government wants you to be a real estate investor. That's why there are so many tax advantages called loopholes available to the investor. There are three main areas of tax benefits available to the serious real estate investor. 1. Tax deductions. 2. Depreciation. 3. Tax credits. Note that we said serious investors. The U.S. tax law limits the amount of tax deductions that you can take from your real estate to just $25,000 of loss if your income is under $100,000. Above $100,000, the loss amount phases out until your income exceeds $150,000, at which point no loss is allowed at all. The loophole is the real estate professional status. If you're a real estate professional, then 100% of your real estate loss, no matter how much, is allowed against your other income, no matter how much it is. You might be wondering why we're talking about real estate losses. After all, you're investing in real estate to create income, not loss. That's one of the wonderful things about real estate. You can actually have cash every month that you put in your pocket and still legally show a tax loss. That gets claimed, deducted, against other income. Tax deductions. There are two things that the government wants you to do. 1. Start businesses, and 2. Invest in real estate. If you do one or both of those things, you will be rewarded with government-sanctioned loopholes. Can you imagine what it would be like to know that you're making more money than ever before and paying less tax and doing it all with the government's blessing? Many people find it hard to start a business, but investing in real estate is more passive. It still requires some work, especially in the beginning, but it is more achievable for most people than most other wealth-building techniques. Now, here's the good news. Real estate investing is also a business. You can now take advantage of all of the tax benefits that are available to the business owner. That can be a big change for someone who has always been an employee, used to following the earn tax spend syndrome of the employee, where you earn money, pay tax on it, and then spend what's left. As a business owner, you can take advantage of legal tax loopholes to use the earn-spend tax solution of the business owner, where you earn money, then spend on legitimate deductions, and pay tax on what's left. In other words, there are some items that you can pay for with before-tax money. Here are the 5 most common business deductions for real estate investors. Kids. If you've got kids, we're sure you'll agree that they do cost money. You can pay some of those expenses with before-tax money by employing them to perform tasks for your business. These need to be legitimate tasks that are age-appropriate. For example, you can hire your 12-year-old son to file paperwork for your business, but it isn't reasonable to hire your 6-month-old daughter to put up a website. Legally employ your child in your business. Follow these 3 rules for proper record keeping when you employ your child in your business. 1. Have a written job description for your child. 2. Your child should keep a time slip or worksheet showing hours worked. 3. Pay a reasonable wage for work performed. Real estate travel. Real estate is everywhere. That means that there are opportunities everywhere to buy real estate. It also means that there are real, legitimate business deductions for real estate buying trips. You must be serious about being a real estate investor in order to take this deduction. For example, Dolph and Diane both buy real estate around the world. They can both take deductions for the trips to other countries to investigate the real estate market. Even better, they are truly diversifying their real estate investing portfolio by investing outside of the box of traditional home country investing. Your travels don't need to be that exotic. It could be simply looking in the state next door to your own home state. Regardless of where the travel is, you must show that you did investigate real estate opportunities while you were there and that you are a serious real estate investor. Keep a journal or make a note in your PDA as to what you saw and the people you met with. And also keep copies of the sales literature and contacts you make when you travel. You can take a deduction only for the business days portion of the trip, so make every day a business day. Home office. The home office is one of those misunderstood and underutilized deductions for businesses. First, let's look at the 2 requirements for having a legitimate home office deduction. Then, we'll review the little twist to make sure you get this deduction for your real estate investing business. In order to take the home office deduction, you will need to have a portion of your home used exclusively for business purposes. You can't simply use a corner of the dining room table or the kitchen counter. It needs to be a spot that is used only for business, and it needs to be a place in which you regularly conduct some kind of business. Those are the 2 rules. 1. Exclusive business use, and 2. Regularly conducting some kind of business. Once you have established a legitimate home office expense, you can then take a pro rata portion of the home-related expenses, such as mortgage interest, property tax, insurance, utilities, maintenance, and the like as a deduction. This proration is determined by dividing the square footage of the business use by the total square footage. You can also depreciate a pro rata portion of the home. Now, here's the real estate investment twist. If you own property managed by others, then the income would be considered investment income. That means that you would not be able to take advantage of the home office deduction. However, if you actively manage your portfolio by overseeing your property managers and the wealth you are accumulating, that then becomes your business. That means you have the business use requirement covered for your real estate investments. Auto. Aside from your children and your house, your next biggest expense is likely to be your automobile. Your auto is often a critical part of your real estate investments as well. The business use of the auto is deductible in one of 3 ways: cents per miles of actual usage, portion of a lease payment, or portion of the actual cost of the vehicle. Education. A successful real estate investor is always improving her education. Tapes, seminars, magazine subscriptions, real estate investment club dues, they are all deductible. In fact, the cost of this book is deductible for a real estate investor. But did you know that the cost of a public speaking course or motivational seminar is also deductible? If it helps you become more effective in your business of real estate investing, it's going to be deductible. Remember though, you need to be a serious investor. That means you're really actively involved in real estate. And you'll need to keep good records of the education that you get and the payments for that education. How do I deduct my car? Keep a written log for business and personal use for at least 3 months each year. If you lease the car, use the percentage of business use times the payment. If you own, is it a current year purchase that is greater than 6,000 GVW, gross vehicle weight? If so, you have a special Section 179 deduction that means you can bypass the depreciation requirements. If you own it and it doesn't qualify for the special Section 179 deduction, you can take either cents per mile or a percentage of actual use. Use the cents per mile method when you put a lot of miles of your vehicle each year and the cost of the auto is relatively small. Depreciation. We just covered the top deductions for a real estate investor. All of those deductions took after-tax expenses and turned them into before-tax deductions, provided you legitimately have a business and can demonstrate that these expenses were ordinary and necessary for production of income. Now let's look at a deduction that doesn't cost you any out-of-pocket money. We call it a phantom expense because it's a legitimate tax deduction that doesn't cost you anything. That wonderful phantom expense is depreciation. This is the best tax loophole of all for real estate investors. Even though we know that property tends to go up in value, and we call that appreciation, the government lets us pretend that it actually goes down in value over time. In fact, they say, if you have a residential property, it will be worthless in 27.5 years. A commercial property has a little longer life, 39 years. By the way, those are the depreciable lives for the building shell. The land is not depreciable. And the personal property, also called chattels, will be depreciated over shorter lives. Check out www.chattelappraisals.com for advice and assistance. Insider tips for maximizing depreciation. Break out land using the fair market value or assessor's percentage of land versus improvements applied to the basis, whichever is less. The less value in the land, the better for you. Break out the value of personal property items in the basis. List these for your accountant. When you buy new personal property, clearly separate the value. Amortize the cost of tenant improvements in commercial buildings over the life of the tenant's lease. Tax credits. A tax deduction reduces your taxable income. A tax credit is a direct credit of taxes you pay. In other words, a tax credit is the same thing as money in the bank. There are 3 major tax credits available to the real estate investor. They are 1. Americans with Disabilities Act retrofits. 2. Historic building rehabilitation costs. 3. Pre-1936 construction rehabilitation costs. Retrofitting a property to make it more accessible for handicapped persons under the Americans with Disabilities Act provides a tax credit of up to 50% of the costs of the retrofitting. Costs over the yearly limit of $2,500 may be carried forward. Rehabilitation costs to a historic building may be taken as long as the building retains 75% of its exterior walls and looks the same as when it was originally constructed. A tax credit of 10% is available for work on buildings constructed prior to 1936, and an additional 10% tax credit is available for work on buildings in city, state, or federally designated areas. Combined with ADA retrofitting, you could see a 70% tax credit on rehabilitation costs. Now, how can you make the real estate benefits even bigger? Chapter 4 will discuss how you can make even more when you take into account the 5 fundamental wealth building strategies.
Action steps. The Insider's Guide to Making Money in Real Estate might look like a book, but we want to let you in on a secret. It's really a guidebook on how you can make money in real estate. Because it's not really a book, we don't want you to just sit back and passively read it. It's not enough to just learn about how real estate and tax laws can immediately put money in your pocket. You need to also be an active participant in creating your own real estate wealth. Now here's the active participation part. Look at the next two categories of action steps. One is for people who already have real estate investment property, and the other is for people who do not yet have real estate investment property. Go through the action steps applicable for where you are. If you own property, complete this for each investment property you own. Do not include your principal residence or any recreational properties. If you are calling them investments, then they should be included. If they really are luxuries and not investments, then realize that's part of your lifestyle for which you need to create passive income, or you'll be working for the rest of your life. The choice is yours. Assess where you are. 1. Property name. 2. Years owned. 3. Total dollar appreciation since purchase. 4. Appreciation per year. 5. Appreciation per year nationally. 6. How does your property compare? 7. Total amount of equity in property. 8. Check value of comparable properties in the neighborhood. Is there room for active appreciation? How much additional value could you create for the property? What would be the cost to perform the work? Could you raise rents if you perform this work? Can you generate either wealth or cash flow by increasing the value of your property? 9. What are 3 things you could do to improve the cash flow on your property? Remember that improving cash flow means raising rents, finding additional income sources, or reducing expenses. 10. Are you taking advantage of all 3 tax benefits where applicable? If not, what can you do right now to begin to put more money in your pocket? 11. Based on the review you just did, what one thing can you take action on right now that can improve your financial situation? Are you really serious about making more money from your real estate? Make a commitment to yourself by signing and dating the following. I commit to performing the above action steps by date, signature, and today's date. If you don't yet own property. 1. Why do you want to own real estate? Please list at least 3 reasons. 2. What 3 things are stopping you right now from investing in real estate? 3. Now make a commitment to yourself to do the following getting ready for real estate steps by signing the commitment at the end of the chapter. Create a chart of passive appreciation for your hometown over the past 5 years. Are you above or below the national average? Determine your ability to get financing. Meet with a mortgage broker, not a loan officer, to review your current creditworthiness. Make a list of 5 things you do really well that could be used to build your real estate fortune. I commit to performing the above action steps by date, signature, and today's date.